one of the things I've been analyzing is the question of what does the Fed understand that they're not saying versus what do they not understand? That's actually kind of an interesting question, because prior to this whole COVID fiasco and the money printing and the financial pressure and the inflation, BlackRock, with a former Fed official, released a report saying in the next downturn, because debt's so high and because interest rates are so low, we're going to have to print a lot of money and probably do helicopter money, so probably fiscal stimulus combined with that. But that could be somewhat inflationary, so they're going to have to hold interest rates low for a period of time despite that. So you're going to have kind of coordination. And then the big challenge becomes how to not have inflation get too high and out of control. So like the whole roadmap was there. I mean, they saw basically everything. And there are a number of analysts like me and others that were, we had been reading things like that, and we've been doing our own kind of similar research and saying that's basically the problem. And so when it starts to play out in real time, central banks never come out and say, look, the sovereign debt's too high, so we just have to hold rates low and financially repress everything. I mean, they never just say that. They never say we have to inflate the debt away. So they have to use euphemisms. They have to kind of phrase it in different ways. And so the question then becomes, what do they know that they just have to phrase differently or kind of push the can down the road and kind of mislead people versus that they think they're doing the right thing? And so, for a while, the Fed and other central banks were saying it's transitory, when a lot of us knew that it wasn't, or at least not nearly as transitory as they think it will be. I do think that the Fed and other central banks are facing a competence, kind of crisis here, where their tools have always been kind of lagging indicators, right? So they're not very good at forecasting. If you look at the Fed's track record of forecasting, basically what they do, they never predict a recession because they're kind of an inherently political organization, right? So predicting a recession is kind of an inherently political statement in some ways. Even if it's not, it just comes off that way. So they never predict a recession. And what they do, basically, no matter if things are high or low, they kind of point back to everything's going to go back to 2%. That's all they do. They basically just draw a line from wherever it is now to 2% inflation and 2% GDP growth and 2.5% interest rates. And they just are always kind of going back and trying to point towards that medium, and they don't really have a good track record. And I think that that's all kind of being marked to market or being kind of realized now, because now they're facing this kind of more endgame type of scenario, the super high debt level combined with inflation, which is just not something that their tools are well equipped to handle, and something that they contributed over decades to getting us here that they don't really have the tools to get us out of. And so I do think that, in countries around the world, especially these developed markets that have these super high debt levels, so Europe, Japan, United States, I wouldn't want their job because it's an impossible job, and you either have to lie or, you have to be stupid or kind of look stupid. And it's an inherently challenging environment to be in, right? So I think that they face a credibility crisis, and it's partially because they contributed to it, but it's also partially because their predecessors contributed to it, and that's just an inherently rough place to be in. I think that the model itself is old. If you ask most people, are price controls a good thing? Should the government set prices of things? Most people would say no. Whereas in the United States, we've had price controls on money since 1913, right? We control the price of money. Basically, a group of elders gets in a room every 6 weeks and determines what the price of money will be. And it doesn't matter where you are in the country. I mean, this is a country of 330 million people, 50 states, very different markets, and they kind of set the nationwide price. And then also, because we're the global reserve currency, this has international ramifications. And it's literally because a group of people in a room are determining that price. And so I just think the model itself is kind of antiquated, and that as software eats the world and as we kind of go through a somewhat inflationary crisis, I think the shortcomings of that model are kind of being laid bare. So the 1930s were a pretty disinflationary decade, and that's because you had the popping of a private debt bubble, and so you had basically underutilization of existing capacity. So you had commodity oversupply, you had low economic output, and the economy had a tough time kind of bouncing back and responding to that. Whereas I think that to the extent that we've run into a calamity this decade, and I think we're seeing kind of early signs of one due to energy crisis, I think it'd be more of an inflationary type of depression. If I look at the bottlenecks of what could make this decade really, really bad, it's, partially what's happening with the money system, but it's more so what's happening with the real movement of essential goods, right? So it's really about, can people get the energy they need? And energy is kind of the master resource that affects everything else. So if you look back in history, even though individual countries can kind of reduce their energy use, the world almost never reduces its energy use because, like, there's so much developing countries around the world. There's still people that need a lot more energy. And even the countries in developed markets that have been able to kind of flatten their energy use, it's in large part because they shipped some of the most energy intensive production to those developing countries. So they kind of got it off their balance sheet and out of mind, even though they're still actually benefiting from that higher energy consumption. And the only times where global energy usage went down year over year, one was, a kind of a 3-year period in the early 1980s, which was basically when Volcker basically put, kind of the U.S. into a severe recession. You had a Latin American debt crisis, you had a big dollar spike, and you had this kind of just really rough global macro environment for a few years. So that was number one. That was actually the last time that consumer sentiment was anywhere near this low, was that period, right? So that was a terrible period for almost everyone. The other one was the global financial crisis. You had 1 year of, less energy usage than the year prior. And then the third instance was 2020, the whole COVID crash, and basically, economic lockdowns and shut-ins and reduced air travel and things like that. And so generally reductions in energy consumption are associated with the worst economic environments in modern history, right? The whole kind of post-World War II era. I don't have data for energy consumption during the 30s, but it would not have been pretty. That's one of the key things to look at is if we do have serious trouble getting the energy we need, that's where you can get really bad humanitarian outcomes. And it doesn't affect everyone equally. It depends on where you are physically, what resources you have available to you. That's the thing. Like if there's an economic thing that keeps me up at night, it's about energy security, energy distribution, and then all these kind of other things come later. So the money system, all that is really bad. At the end of the day, it comes down to, can we get energy? Can we heat our homes in the winter? Can we get food on the table, right? Because even, a lot of fertilizers are made from natural gas, right? And so if natural gas, like in Europe, it just looks like a Weimar chart, that making fertilizer in Europe is going to look like a Weimar chart, right? So basically, it really comes down to whether or not we have abundant energy. Basically, if you look at oil is more fungible than natural gas. So oil is pretty easy to transport around the world. And so you can get kind of dislocations in price, but it's generally pretty similar prices around the world. And so Brent crude and West Texas Intermediate crude, there could be brief anomalies where they differ, but for the most part, they're rather similar prices. And, right now we saw a dip in oil usage, but we have to keep in mind that the U.S. Strategic Petroleum Reserve, so the oil that the government controls, they're actively selling oil into the market to try to suppress prices that they can't do forever for obvious reasons. They only have so much. We also have China's been under lockdowns for, a large part of the spring and even now. And basically, they have unusually low jet fuel usage and car usage because they have essentially suppressed their economic activity. So the two biggest countries in the world are either increasing supply or suppressing demand for oil. I think that, you have periods of time where it gets ahead of itself, people bid up the price, and then you have kind of, pullback, you have demand destruction, you have recessionary type environments. I would be slow to celebrate those pullbacks because I think that the underlying supply constraints are still there. And so I think that those can bounce back quickly, or if they keep going down, it's a sign of basically depression. It's basically a sign of recession happening. Natural gas is a less fungible energy source because it's much harder to transport. If you want to transport internationally, you need LNG. Right, so you either need to, transport over land with pipelines usually. Those take years and years to build. They're very expensive. Or if you want to transport it by sea, you need LNG, which means you need these multi-billion-dollar facilities to cool it. There's this whole technical process to, basically liquefy it, transport it, and then unliquefy it. And there's kind of a firm amount of LNG capacity that we have because these are multi-billion-dollar facilities that we don't just switch on overnight. So basically the result of what I'm saying is that because natural gas is more costly to transport relative to the value of the product, we have much different prices around the world for natural gas compared to oil that is pretty unified. And so right now, for example, European natural gas prices are absolutely through the roof. They're multiple times higher than you see in the United States or Canada because they have an energy crisis. They get a lot of their natural gas from Russia. So that's obviously a geopolitical problem right now. But that was already happening before the war. They were having limitations there, and their ability to get natural gas from overseas is much more limited than their ability to get oil from overseas because the capacity to transport natural gas is much more limited and takes a lot more money and time to get that capacity online in order for, say, Canada to ship over natural gas to Europe or the United States to ship over natural gas to Europe. And so I think the two markets to watch, one is just global oil prices, but then two, natural gas prices, especially in specific regions. And then also, I mean, as a fallback, Asia uses coal quite heavily because they don't have a lot of oil and gas deposits, so they use a lot of coal, despite the fact that it's dirtier in most ways. And we're actually starting to see in Europe that some of those markets are falling back on coal, basically due to emergency conditions. They have not built new nuclear facilities. They're at their limits in terms of natural gas. That whole market's breaking, and they can only get so much oil, and so they have a fallback on coal. Basically, looking at these markets are some of the underlying things for kind of near-term, intermediate-term energy usage.